To live and exclusive Investonomics conversation on recently launched and now a very popular book, Diamonds in the Dust. This conversation with the esteemed panel of guests, the authors of the book, is brought to you by ICICI Direct. It's a great pleasure for me to introduce our speakers this evening who will talk about their book, Diamonds in the Dust, and I'm sure every one of us will be deeply interested as it deals with a subject that will best ensure our financial futures. Let me begin by introducing my panel this evening. Joining me now is Mr. Saurabh Mukherjea, a fellow of the Royal Society of Arts and an alumnus of the London School of Economics. He's the author of 4 best-selling books on subjects including investing, business strategy, and self-improvement. Saurabh manages Marcellus Investment Managers. My next panelist today is Mr. Rakshit Ranjan. He's a BTech from IIT Delhi and a CFA charter holder with a total experience of over 16 years in equity investing. Rakshit manages Marcellus' flagship Consistent Compounders Fund. Mr. Salil Desai is a chartered accountant and MBA. He has spent over 16 years in covering diverse sectors in the Indian equity markets. He currently manages some of the large advisory portfolios at Marcellus. Welcome, gentlemen, and thank you for joining me today.
Thank you very much for inviting us.
So let's get started. Please give a brief introduction about what this book is all about.
Sure. So thank you very much. Thank you very much to ICICI Direct for inviting us to talk about Marcellus's latest book, Diamonds in the Dust. The book was published a week or so ago, and as you very kindly pointed out, Vitu, it's gone straight to #1. So what we'll just do is give you a sense of why did we write the book, right? It takes a lot of hard work to write the book. There's a lot of excitement these days about investing in the Indian stock market. Forget newcomers, even the vast majority of seasoned investors in India don't understand how difficult it is to consistently make money in the Indian market. And we've given you some numbers to help your viewers come to terms with the challenge on hand. Although there are 6,000 companies listed in India, just 10 companies now account for 90% of the profits generated by the Indian economy. Just 16 companies, 16 companies account for 80% of the wealth generated by the Nifty 50 over the past decade or so. And on the other hand, right, the negative side now, not only have 50% of index constituents over the last 10 years faded into obscurity, a mere 15%, just 15% of the stocks listed in the BSE 500 a decade ago have delivered returns above cost of capital. So as a result, generating consistent returns from the Indian stock market is much harder than investors, even professional investors, understand it to be. What Diamonds in the Dust does, what our book does, is lays out a method which investors can use to swing the odds in their favor. Now, how does it work? How can you swing the odds in your favor? I'll request my colleague Salil Desai to explain how this works.
Thanks, Saurabh. Right. So the first rule in investing is always to not lose money, right? And one of the reasons why you should not lose money is to make sure that you're investing in companies where the accounting quality is very, very clean, right? Now, if you recall, most of the times we have memories of only large-scale investment or accounting frauds, right? So Satyam Computers, ILNFS come to mind. But what really happens is that now accounting irregularities are much more widespread and happen more frequently than we tend to think, right? So I'll give you a more recent example, DHFL. Divan Housing was a leading housing finance company, a market cap of close to about 20,000 crores at peak. A forensic audit revealed that about 17,000 crores was siphoned off from the company, right? So that's on a company of such a small size, such a large accounting irregularity that was found. Another example is Cox and Kings. We used to be one of the leading travel services company in India. They went from a positive net worth of more than 4,000 crores to a negative net worth of a little over 7,000 crores in a span of a year. Right? That's a 12,000 crore swing in 12 months. Right? Every month, 1,000 crores, don't know where it is gone. Now, the biggest problem with all of this is that the people who bear the brunt of this are retail investors, individual investors like you and me. So again, to go back to the DHFL example, after people started getting worried on asset quality with the company, the stock declined by close to about 60% in a span of a few months. And this included a 42% decline in a single day. Right? One day, 42% the stock was down. And what happened after this decline? Retail shareholding in the company went up from 17% to 48%. And today, the company is most likely going to get delisted as part of its insolvency resolution, which means the value of equity is zero. Right? So these 48% people, the people who own half the company, retail investors, are going to get nothing, right? Zero, zilch. And this happens, because most of the times the retail investor does not have the tools to detect accounting frauds in advance. If that was possible, then they would avoid losses. And one of the most common things that also happens is that after the stock has fallen, retail investors tend to think that now it is cheap, there's a turnaround possible, and that is when they try to enter the stock. But these turnarounds are hardly ever happen. So what is really needed is that you need a checklist of accounting quality and governance standards before you take the first step in investing. Now, once you've done this, what to do next to find the winners? I'll request Rakshit to please take you through that.
Thanks, Salil. So folks, an interesting data point about India's stock market is that indices like, say, Sensex and Nifty, they do not outperform India's nominal GDP growth rate, despite benefiting from things like survivorship bias and selection bias into the index. And this lack of outperformance, we believe, is largely due to the dodgy accounting practices followed by many large dominant businesses in India, which Salil talked about. And hence there's a massive alpha to be had only by focusing on clean accounting practices itself. Now, on top of this alpha, there's also need to come to bring alpha from picking companies which already have clean accounts, but also have high quality fundamentals. And there are three broad characteristics of a high quality company which an investor needs to target. The first one, which is in this bubble diagram on the left, is about the firm having a very high pricing power. Now, what does that really mean? The pricing power definition is not just the ability to hike prices in order to protect margins in the face of intense competition. In the face of rising raw material costs. It also means that if a competitor kicks off a price war and offers a product at, say, 30 to 40% discounted price points compared to the incumbents, then does that have any adverse impact on either the market share or the profitability of a great franchise, right? And in chapter 4 of Diamonds in the Dust, we've provided a total of 10 case studies of companies which have such high pricing power, including the likes of Abbott, Pidilite, Divi's, Garvare, so on and so forth. And that's just one element of a high quality company. The second characteristic, the sort of circular diagram in the middle, is of a high quality company using the outcome of high pricing power to deliver longevity of cash flows. So the outcome of high pricing power is strong cash generation that should get reinvested in the business whilst also sustaining high pricing power in the incremental avenues of investment. And this is harder than it sounds, actually, because most successful businesses, they fail to maintain prudence while allocating capital to grow beyond their core products and markets. And again, in Diamonds in the Dust, in chapter 5, we've given a framework, a checklist to assess capital allocation decisions with more than 20 odd examples of prominent and successful Indian companies, majority of which, interestingly, had an adverse impact on shareholder returns from their capital allocation decisions. And there are also 3 very detailed case studies in the book on companies such as Tata Steel, Pidilite, and Kotak, around their capital allocation decisions and hence how they transformed the fortunes of those companies. The third characteristic, which is in the sort of flow chart on the right, is about high quality companies being institutions rather than one-man shows, one product shows. Right? The institution building at such companies needs to happen at broadly 3 levels. Right at the top, board of directors should be decentralized in strategic decision making. Secondly, the CXO layer should have a process of selection of the individuals and succession of these individuals. And thirdly, there should be a very decentralized process of execution of the business at the ground level. And in the book, we've given comparison between two apparently similar companies, as in on this institutionalization front, people believe that Asian Paints and HDFC Bank are fairly matured. but we've shown by means of some examples how they're actually not at all similar, and an investor needs to deeply understand the differences between such mature companies as well in order to balance the risk reward of their overall stock portfolio. Now, coming to the outcome of picking up stocks in this manner. So the first layer of outcome of investing in say consistent compounders is that and these three charts, the chart on the left and the two exhibits on the right, they are of Asian Paints. But in the book, you'll see that even other companies which are consistent compounders have very similar outcomes. First and foremost, the rate of compounding of such companies is exponential in the long run compared to the broader markets, which you can see in the chart on the left. At around 25-26% rate of compounding, share prices become 10x in 10 years and 100x in 20 years. Now, not only is the rate of compounding exponential, it's also in the charts on the right, you can see that over the 20-year time horizon, when you break down the 20 years into 12-month time periods each, first of all, unlike say the Nifty 50 index, which is the histogram at the bottom, unlike Nifty 50 index, the consistent compounders, the histogram on the top, there are very few instances of negative returns, right? Which is in a way saying that the histogram is more right skewed, and there are very few instances of negative returns on the left half, right? Not only that, even within the positive year outcomes, there's a distinct right skew towards the bucket of more than 30% annualized returns, right? For 12-month periods. And when you compare this against say Sensex or Nifty, the 10 to 20% return bucket is more frequent. Now, this in a way also means that rather than worrying about say mean reversion or profit booking as concepts of sort of selling stocks once they've delivered good performance, these histograms are telling you that staying invested over the long run is substantially more rewarding than sort of timing entry exists. So that's the broad essence of the outcome of investing here. And yeah, I'll request that at this juncture, sort of Geetu to take over for any more questions that you might have on these concepts.
Thank you, Rakshit. But it's like very interesting to know that only handful of companies contribute 80% of the wealth in these markets that we are operating. Saurabh, my first question is for you. What prompted you to write this book on the subject now, when the markets are at record highs and people are, riding the tide? They are making huge money investing in mid caps, small caps, in very short period of time. So,
right.
Why this book now?
So I think, look, let's first focus on the good news. I think the good news is finally the Indian middle class has stopped buying flats and gold and fixed deposits, and finally they've come into the Indian stock market. That has to be celebrated. Remember, the RBI has said that 95% of Indian household wealth is in physical assets, which obviously is a disaster, right? 95% of people's money being in flats and bars of gold is not going to help them create wealth. So the fact to be celebrated, right, and who better than ICICI Direct to celebrate it, is the entry by the Indian middle class into the stock market. Great news, right? We should be delighted. But what worried us and what compelled us to write the book is, we've seen before and we're seeing again in this bull run, is a lot of naughty companies, right? The companies where our forensics are telling us these are fraud companies. They are obviously pulling in retail investors. They're advertising themselves. They're doing promotional activity. It's not shown as promotional activity in the public domain, but it is promotional activity. And as was the case with the fraud example Salil laid out, Cox and Kings and DHFL and Deccan Chronicle, the next generation of naughty companies are pulling in retail investors. Now, we aren't all powerful, neither are we all knowing. But we don't want to see another generation of Indian retail investors lose their money on naughty companies. Because if they do that, once again, the process of financializing wealth will be set back by another 10 years. So in the interests of our own industry's benefit, which is also our benefit, we said, let's write a book which tells millions of people out there that, look, by all means, come into the stock market. It is the best best way you can compound your wealth, but don't go and invest in random companies. There's actually a handful of companies, I would say no more than 20 companies in India, which will compound your and my friends' families' wealth. And we said, let's show the public the names of those companies and the process via which they can be identified, because it will help the public make more money. It will help our industry. And by helping our industry, we are in effect also helping Marcellus investment managers.
Rakshit, my question is for you. Since Saurabh said that it's a handful of the companies, and the new retail investors who are entering into the market, they are very price sensitive. They won't go for companies which are being priced at a higher price. So in such a situation, why is it important to really look for test cricket players and not encash the opportunity which is being offered by players who are paying 2020 in the market?
A very good question. So the basic difference between Test cricket and 2020 is longevity, right? There are two elements of longevity. One is the longevity of the format itself, as in 5 days discipline required compared to 2020. And second is also Test cricket batsmen, when they build their careers, it has to be built over several years, right? The longevity of the batsman itself. You can't really have a Test cricket player who played very well for 1 year and then didn't, whereas you can have that sort of a phenomenon in a T20. Now, when it comes to stocks, especially when it comes to high quality companies, the biggest element of undervaluation is longevity of these franchises, right? If you pick up two companies, both compounding cash flows at the same rate, let's say 20% over the next 3 years, right? If one of those companies stops compounding cash flows beyond the next 3-4 years, and there's a lot of uncertainty that today you have to bake in for that halt of compounding 3-4 years hence, compared to another company where you have a lot of certainty that either because it's an institution and on top of it, disciplined capital allocation, you can foresee that 10-15 years, no one can disrupt or dislodge the dominance of this company or the profitability, then the valuation, the fair value differences between the two companies can be as much as 10x. So one company might be fair valued at 20 times P multiple, the other one might be fair valued at 200 times. And hence buying a 200 times P multiple, regardless of whether it's at 20 times entry or 50 times entry PE, right, is a very, very incredibly attractive proposition.
Salil, your book describes and dismantles what you call myths about the market. What are some of them?
So myths about the stock market in particular, there are you can say primarily two of them. The first is that people think that timing the market is something which is important, which is relevant, and more important, they can do it. The second myth is that if you buy a cheap stock, you make money, right? So which Rakshit was just explaining. Now let me give you a bit on the timing aspect of it. Let's take an example from last year. On 14th of Jan 2020, what happened was at that time the BSE Sensex had recorded its all-time high. From Jan to March, as COVID began spreading, the market corrected by almost about 38% in less than 2 months. And then on 24th March, the nationwide lockdown was announced. The economy came to a standstill. Now, you would have thought at that time that this is the things will get only worse from here, and every economist, market commentator was telling you the same, that there's going to be long bear phase in the markets. But what really happened? On 24th of March, right, when the economy shut, the market bottomed. Right? And from there, you have seen what the journey has been. Right? The market is of more than 100%. The point here is that it's practically impossible to time the market. Right? And even if, let's say, by some magical formula, you are able to find the exact bottom of the market and exact peak of the market, and you buy at the bottom, sell at the peak. But by doing this, so we have shown with examples in the book where, let's say, you buy a consistent compounder stock. Right? So you focus on a good quality company. When you buy it, it actually becomes immaterial. So we have given examples of two people. The one we call him Mr. Gifted, who buys it at the exact 52-week low for 10 years in a row, every year, right? Perfect timing. And then we have somebody called as Mr. Mortal, who has no idea what's going on. So he buys it on a random date, the 1st of January every year, for example. And now, if both of them do this exercise for 10 years, investing regularly, the return differential at the end of 10 years is less than 2%, right? Between 1.5 to 1.8% approximately, exact numbers. So which means that after 10 years of perfect timing, right, the guy who's a perfect market timer has got what? Less than 2% extra returns. And you could take these examples even on the index as a whole, right? And you will find that absolutely no value in trying to time the market. So that's the biggest myth I think we've tried to bust here. And the efforts that you spend in timing, you'd rather spend it in finding quality stocks. That is where you're going to make money.
So this is page 200 of Diamonds in the Dust. I have to confess, even I was blown away when Salil produced this analysis. The fact that even over 1 year, 3 year, 10 years, there's no money to be made by timing the market. In fact, for some of the consistent compounders like Asian Paints, some of the analysis that our team has done, which is in chapter 6 of the book, shows you that even if you buy Asian Paints at the year's high, forget timing it, assume it's the reverse. Suppose you're the unluckiest investor in the world, provided you have chosen a consistent compounder like an Asian Paints, a Pidilite, or an HDFC Bank, right? Or Titan, these sorts of names. Even if you buy it at the year's high, Gitu, provided you keep investing every year for 10 years, even then you end up with returns of 22, 23%. So the higher the quality of the stock, and especially when we're looking at consistent compounders, premium quality stocks, clean accounts, good capital allocation, high barriers to entry, with these sorts of names, timing is not only rendered irrelevant, even if you mistime it perfectly, you still end up making good returns. It's just mind-blowing analysis in the what to buy and when to buy chapter of the book. If there's nothing else that you're interested in, I'm just talking to the audience. If there's nothing else you buy the book for, just read chapter 6, when to buy, and it will set your mind at rest that market timing is the most useless activity on the face of the planet.
So should one be buying high quality franchisee which are trading at high valuations right away? Don't wait for corrections. Don't wait for
So how will you know? I mean, just to answer the question rhetorically, there'll be no bell that will ring in the local temple saying the time is now right? There's a temple not very far from my house. The bell does ring every evening, right? So I'm not going to know when to buy, right? Because the bell rings every evening. Now, maybe you'll say, maybe some other ghanti will ring, right? Maybe in your brain a ghanti will ring. And this is not the right time to buy Asian Paints. Unfortunately, in our brain, no bell rings. So we every day, literally every day, we buy high quality companies for our 8,000 clients. And we haven't met any other investors, and we've spent our entire lives doing this. We invest money for some of the world's largest endowments. We haven't met any investor who's reported to us that a bell rings in my head saying today is the right time to buy.
But my question now is that if that is the case and the companies which are growing at 20-25% CAGR, how do you assume that they will continue growing at that pace?
That's exactly the point of the framework Rakshit took your viewers through, where he laid out how you assess pricing power, how you assess the ability to reinvest high cash flows. So remember, Rakshit made 3 points, right? And this is the middle bit of the book. Firstly, you have to figure out what drives the barriers to entry. Why does the company have barriers to entry? For what reason is it able to keep competitors at bay? You got to get a very good grip on that. If you don't have a grip on that, honestly, you shouldn't be investing. Secondly, if a company is able to keep competitors out and they have high pricing power, they end up with high free cash flows, right? They have surplus resources. So the second bit Rakshit explained was you look at the promoters, the management's ability to reinvest surplus resources. And the third bit is, even if the company is doing well on all this, is it a one-man shop? Is it a Lala Ki Dukaan? Or is it a proper franchise, right? It's a process-driven, team-driven operation. Obviously, if it's a Lala Ki Dukaan, right, the sustainability is low because when Lalaji keels over, the game is finished, right? So 3 bits on the sustainability point, you're absolutely right. Even if the company is doing well today, how do you and I know it will do well tomorrow? And that does require a degree of work on comparative advantages, capital allocation, and sustainability. And that again is the chapters 3 and 4 of Diamonds in the Dust.
Also, Gitu, just one thing here, you don't have to assume that they'll do well. You actually have to observe, watch them like a hawk, literally day in, day out, because nothing lasts forever. The great franchises of today might not necessarily be as great as they are today after 5 years, right? So you have to watch them like a hawk and then buy and hold on to them.
Rakshit, why I raised this question was because business cycles are changing. Your new business models are emerging. There's digitization happening. There's mobilization of economy happening. So many new players will, emerge, and maybe the old economy companies do not do well.
Correct. No, your point is very valid, and that's one of the reasons why very few companies they sustain greatness. Right. What we want in such a portfolio is companies which actually drive that change rather than get disrupted from the change. These are companies which disrupt their competitors. They radically change the way business is conducted in their industry so that competitors can't replicate. If it is, let's say, take for instance, next 5 years, God knows, blockchain will be adopted in which parts of the economy. If our portfolio companies are not using blockchain to disrupt their competition and instead are waiting for blockchain to disrupt them, then they are not great companies. So by definition, great companies are those which will actually benefit from all of this evolution and disruption in the external world.
Salil, I read a few lines from your book, one of the chapters, which says that building confidence in the sanctity of the financial statement and the broader corporate governance of the company should be starting point for any stock analysis. And I'm sure most of the analysts would be going through the financial statements before deciding on which stock to buy and not. Nobody would have thought about, companies like that you pointed out, GHFL, Reliance Capital with big names, ILNFS, which was promoted by the bureaucrats, failing. I mean, how do you really analyze these financial statements? Are you sure about the transparency of the financial data which is being shared by the corporates?
Okay, and again, a good question, Neetu. So, see, what you need to do is there are, again, in chapters 2 and 3 of the book, we have laid a process out where you can do this. So the one is you do what we call as level 1 checks, right? So these are, you go through the financial statements and there are a set of accounting ratios. We have again given those ratios in the book that you analyze, right? So you analyze that for a set of companies, right? Which will tell you the companies scoring high on all of these ratios, the results of these ratios, and companies which are scoring not so well or low on this ratio. So you have a gradient, and then you pick the best of that lot. Now, like you said, are you sure of the transparency? Maybe these numbers are not what they seem to be, right? Because the reported numbers could be wrong. So once you have a set of these companies, then you move on to what we call as level 2 and level 3 checks. A level 2 check is looking at non-financial numbers, right? So let's say board of directors. How independent are the independent directors on the board? Now, are they friends or family members of the promoter, or these are genuine professionals who can add value, who can, more importantly, stand up to the promoters and ask hard questions, right? If there is some decision being made or something being, let's say, hidden, right? We want a board to represent minority shareholders and ask these tough questions to the management. Then you check on things like what is the tenure of the board of directors. Sometimes you'll find that the board has not changed for 10-15 years. Now, obviously, there are regulations to prevent that. But in the past, there have been cases where the board of directors have been there regularly. How frequently are auditors changing, right? An auditor resigning without reason. It might not be anything wrong as such, but it's something which you should obviously check. And then finally, after doing this, you do what we call as level 3 checks, is you go and try and talk to, let's say, everybody who's in the value chain in which the business operates. So you might, let's say, want to speak to raw material suppliers to the company. Right? They will tell you things about how they operate, ethical practices, and so on. So combination of all these three will tell you in advance that is there something which you should worry about, right? In the first stage, it might not be a conclusive evidence, but at the end of this, at least, you know that this is something you want to avoid. It's not worth the risk, right? It's not necessary that it turns out to be a fraud, but it's just not worth the risk.
Okay. Sort of my question to you now, we all know that our economy has been going through a very tough phase. It has been from a couple of years that we have not been doing well, and COVID has really added to our woes. Now that we are expecting the economy to recover fast, Do you expect this limited number of stocks that you're talking about to really play out? How will you play out the recovery theme with these handful of stocks?
So Gitu, we are, thankfully, we work for Marcellus Investment Managers. Thankfully, we don't have the much tougher job. The much tougher job is by the people in the finance ministry. They have to worry about the economy, recovery, kaise hoga, kab hoga. We are thankfully in the limited context of making money for our clients. And our goal has been, we're not here to focus on economic cycles, to do forecasting on economic cycles. Other people in the RBI finance ministry, they have that headache. And my support and my commiserations to whatever extent I can offer it as an economist with them, because it's very hard. Our job is to invest in companies which are selling the essentials of life to Gitu, to Rakshit, to Salil, to Saurabh, right? Products that all of us need to live day to day. Paint, baby milk powder, undergarments, medicines, blood tests, right? Within that context of companies whose products sell every day, whose products are essential every day, we are saying we need to see three things. We need to see that the promoter G is running a clean show, accounts are clean. Secondly, we need to see that promoter G is a rational, intelligent person and allocates capital in a rational manner, return on capital above cost of capital. And finally, we need to see that the franchise is dominant, it has high pricing power, right? Our job is that limited context. And the great news, the news which is why we exist, we are able to manage 10,000 crores for 8,000 families, is in India, because our country is still at such an early stage of development, this style of investing allows you and me and 7,000, 8,000 Marcellus clients to consistently compound at around 20%, which is why the book is called Consistent Compounding for Extraordinary Wealth Creation. There are other people who can write a book called Inconsistent Compounding by timing the GDP cycle. There's another book to be written by somebody else called Inconsistent Compounding by timing the GDP cycle, but we don't have that skill set. We're not interested in timing GDP growth. We don't know when GDP will recover, when it will fall. We hope it'll do well, the country will do well, but we don't need the country to do well for our companies to do well. Our companies are selling the essentials of life to all of us who are watching this program, products with which we cannot survive. They are dominant, they are smart, and they make money for their shareholders. These consistent compounders make money for their shareholders, regardless of whether GDP growth is 8% or 2%.
Rakshit, does stock price tell you the reality of the franchise?
No, not at all. It's actually the journey starts with the quality of the franchise, and it ends with the quality of the franchise. The stock price has no role in assessing the quality. In fact, once you are very well assured of the quality of the franchise, there's a very, very high probability that the stock price doesn't fully capture the quality. Very few such companies have such high quality. For those companies only, there's a very high probability that the stock price doesn't capture the whole longevity.
In fact, Gitu, this question is actually very relevant for the ICICI Direct clientele. Yeah. ICICI Direct clientele, I presume, are hardworking, middle class, upper middle class people who are trying to invest in the stock market, right? Unko dara kaun raha hai? Unko dara raha hai the fund manager who comes on TV and says, "Give me your money, because God came to me in a dream and told me that this is the right time to buy said stock." So you are sitting, in your house, middle class person. Aapko to pata nahi hai what is the right time to buy the stock. I am the fund manager. I have divine insight on that subject. So आप अपना पैसा मुझे दे दीजिए, मैं आपके लिए करता हूँ, right? But as you and I know, that's a bogus claim. That's a bogus claim. Market timing can't be done by anybody, whether it's ICICI Direct clients or fund managers. Since market timing cannot be done, and Salil provided a brilliant slide, chapter 6 of the book elaborates that market timing is futile. What should the ICICI Direct client do? They should focus on identifying high quality, clean, consistent compounders. If they do that, they can then invest via, I presume, the services offered by ICICI Direct, and they compound. So this whole premise, right, this whole notion that's been created, that share price is important, figuring out share price kab right hai, kab wrong hai, it's a way to delude millions of people into believing that you don't know enough, aapko kya pata, aap apna paisa mujhe de dijiye. right? And we strongly contest that notion. And in this book, we tell you, don't try to time the market and don't obsess कि कौन सा share price is the right price to enter a stock.
In fact, you need to think of it in two distinct ways. The stock price of DHFL and Yes Bank never told you the quality of DHFL and Yes Bank. Similarly, the stock price of an Asian Paints and say a Pidilite has never told you adequately the quality of an Asian Paints or a Pidilite.
Very good examples indeed. But to experience the magic of compounding, it's not easy because people do not have that much of patience to stick around and stay invested in those 10-15 stocks for 10 years.
Yeah, no. Sorry, go ahead. Yeah, so stock market offers excitement, right? And it's for the investor to figure out whether they want excitement or they want consistent performance, right? 90% plus of the stock market will throw excitement at an investor, and investors who take that will certainly not be patient, provided you've really appreciated to the greatest depth the quality of the company. You will get enough conviction to stay patient. Patience actually comes after having understood the beauty of these franchises. Otherwise, yes, there are many people who bought Asian Paints, but most of them would have sold out of Asian Paints prematurely, either in the start of the COVID crisis by saying that, look, labor workforce and painters and contractors will not be welcomed into houses thanks to COVID, and which was actually a fact. But still, Asian Paints gained market share and delivered what it did. Or because, say the management team of a said company has changed and hence the future is uncertain, or Bajaj Finance unsecured lending, 70% fall in the stock price, etc. So if you don't understand the depth of the fundamentals, being patient is very difficult. But if you do, being patient is very doable and rewarding.
Because I'm saying that because aaj ka jo long term hai, that is 6 months only. 6 months is long term in today's.
So which is why we use the cricketing example, right? So there are lots of great batsmen who played for India, बहुत entertain किया, Virender Sehwag, Saurabh Ganguly, VVS Lakshman, all great entertainers, right? And I was massive fans of all of these. But the man who has won, and this is statistical data we quote in the book, the man who has batted more balls in Test cricket than any other player in the history of Test cricket, the man who has won India the most number of Test matches abroad, right? He's the wall. He's Rahul Dravid, right? So you can have entertainment from other people, बढ़िया है, enjoy करो, but results एक ही बंदा दिलाता है. Rahul Dravid deserves results. Rahul Dravid helps you win. That's how investing works. You have to be clear, as Rakshit said. Are you in it for excitement? Are you in it for wealth creation? I'm sure ICICI Direct will want both people. They want some people who are in it for excitement, right? Because in our country it's not legal to bet on sports. So our stock market side excitement low. And there'll be other people who will be ICICI Direct clients who will make a lot of money, who realize that stock market mein wealth creation is their main goal. To each his own. Jisko excitement chahiye, they can still read the book. We'll still be happy if they buy the book. But excitement walo ko zyada maza nahi aayega kitab padhne mein.
Chaliye, ab hum let's take a few questions from our viewers. One of the question is, Marcellus has never been confident about Reliance Industries. May I know the reason why?
No, so there's nothing specific about Reliance Industries that we have been confident or unconfident about. The framework that we have laid out in our books, in our webinars, newsletters, on our website is we look for companies which are generating free cash flow, right? As Rakshit said, if you have pricing power manifest kaise karta hai? How do you know that a company has pricing power? Because the company generates free cash flow. So Reliance historically hasn't generated free cash flow, which is why we have looked at the company carefully, but historically stayed away. We are very optimistic that given the positive steps taken by the company in the last several years, where they have become a key player in the telecom sector, we are optimistic that one day the company will start generating free cash flow, in which case we will consider it for our portfolio then once we see the cash flow. It's a very simple method of investing, right? Which is why we can put it in a 200-page book and give it to the public. Simple method, clean accounting, strong franchise, high pricing power, consistent cash flows, you're reinvesting that. So in our country, as we said at the outset, around 12.5 companies passed the test, and we've written about them in the book, and we invest in them in our consistent compounder portfolio.
Salil, one question for you. How do you define superior capital allocation?
Again, going back to the slide that Rakshit had presented, what happens is that what does a strong franchise let you do? What does pricing power let you do, right? Pricing power allows you to earn returns on capital, which are always higher than the cost of capital, right? You are raising, you're starting a business by raising capital, let's say, whether it be equity or debt. You have to pay both of them something, right? But you have to make sure the business earns more than what you have to pay these capital providers. Now, the difference between these two is your cash flow, right? That's the, so to say, profit, right? But that you earn. Now, the business has a decision to make, right? What do you do with this free cash, right? You do that. You can do two things with that. One is you reinvest it back into the business, right? What that does is it helps you even make a competitive advantage even stronger, right? So you build more moats. Let's say you spend on R&D, which will improve, which will give you an edge over competition. So that's the first thing that you do. Second thing you do is you increase capacity to take care of future growth. The question is that, does the business allow you to reinvest for growth and for deepening competitive advantages? And are you doing it smartly or not? So that is the true test of capital allocation. So you grow without diluting your returns on capital. If you can do that, yes, that's the right test of capital allocation. If not, then there is a problem. And you have to remember that every business, no matter how strong your competitive advantages are, there is always a limit to the market that you operate in. Now, the question is, can the management find avenues for growth which will not restrict them? And if that happens, then that is where you kind of put your money in. And that is what you have to keep regularly testing for.
There's one question from Gaurav Rana, who is asking about Vodafone Idea. What is the future?
Look, I mean, with all due respect, we don't offer a stock tipping service, right? So if people want stock tips, please, go somewhere else. We are fund managers. We manage 8,000 families' wealth. We like writing books. We put our wealth of knowledge or knowledge in the books. But if you want stock tips, folks, there's other ways to get it. Please don't use our valuable time for that.
There's one question from Sunit Mukherjea. What is your definition of long-term investing in today's world? And how do you look at tech-enabled companies like Zomato when it comes to long-term investing?
Rakshit, do you want to have a crack at that?
Sure. So, look, long-term investing basically means that you make money over 10, 20, 30 years. Most investors, or rather most wealth compounders, right? They have a time horizon of at least 20 years. Many of us might have as many as 30 or 40 years before we sort of dip into the savings and the wealth created to fund our whatever it may be, retirement or cash flow requirements. If you can't compound your wealth over a time period as long as 10, 20 years, then just by making money over 1 or 2 years is not going to be rewarding enough, right? You won't be able to meet your financial goals. You won't be able to upgrade lifestyles if that was a requirement, so on and so forth, right? So that's long term, at least a couple of decades or longer, and hence you need consistency over this time period so that you get low risk and healthy rate of compounding. Now, when it comes to technology oriented companies, so there are two or three types of companies that you can find who are tech oriented. On the one hand, you can have companies which never existed till last year. Today, they've come out with a disruptive technology. They might be getting a lot of success in it, and hence they might be a future growth prospect. The second type could be the Zomato type, where they've had a long sort of 10, 15 years of historical track record. They've done things, certain things successfully. They are tech-oriented firms. and then you foresee a future for them. Or the third one could be companies such as, say, an Asian Paints, which are actually a pure tech-oriented supply chain plays. It's not a paint company in its true definition, actually. It's a paint company. It's a tech company masquerading as a paint company in a way. Look at, say a Dr. Lal PathLabs, how it executes its business. It's again more tech rather than so much ad hocism. When you look at these sorts of franchises, the third type, the Asian Paints type, they have not only demonstrated the use of tech in the here and now, they've demonstrated the evolution of their use of tech over last several decades, which then gives you the conviction, the confidence that not only the next 2-3 years basis tech will be great for this third category. Okay. You can also rely on an Asian Paints for a non-foreseeable tech evolution or disruption 5 or 10 years down the line, and be confident that Asian Paints in all likelihood will ride that tech the best. Right? Just like Zomato actually is a tech-based food delivery company, Asian Paints is a tech-based paint player. It's just that people don't fully appreciate it, and hence Asian Paints is not yet a 300 times P multiple, and hence we find it still incredibly cheap. It makes a lot of sense to play tech via some of these companies.
Salil, one last question for you. Successful investing, how will you define it?
See, successful investing, you should define it in 2 ways, right? One is, or actually just one way, is simply consistency, right? I don't want to invest, or nobody wants to invest in a company which makes a profit this year and a loss next year, right? Because eventually the stock price will reflect what the business does. So you want a business which is consistent, so it grows consistently, generates cash flows consistently, and reinvest those cash flows sensibly and consistently. So successful investing is ideally to identify these companies. And once you identify them, sit tight, invest regularly, and be patient. So that's my definition with me.
Thank you, Saurabh. Thank you, Rakshit, Salil, for your time. It was a really wonderful conversation. Pleasure speaking with all of you.
Thank you very much.
For your book.
Thank you, Geeta. Pleasure talking.
Thank you, Geeta. Thank you.